Good morning and namaskar. Over the past few months, the global economy has been shaped by heightened uncertainty, disruptions to key trade routes and supply chains, increased market volatility, and cautious business sentiment. Let me at the very outset emphasize that the Indian economy entered this episode of global turbulence with much better fundamentals than in previous similar episodes. We remain confident to withstand these shocks with minimum pain. Nevertheless, it is important to not only confront and address these challenges, but also at the same time take this as an opportunity to further enhance our resilience. Global economic outlook remains clouded by the continuing geopolitical impasse in West Asia, as sharply escalating energy prices and global supply chain disruptions continue to hinder economic activity. Faced with difficult trade-offs, monetary policy has turned more cautious. Major advanced economy central banks are likely to pivot towards monetary policy tightening. While equity markets remain buoyant, driven by AI-fueled optimism, global bond markets remain bearish amidst renewed inflation fears and continuing debt sustainability concerns. As for growth, the MPC noted that elevated energy prices, coupled with global supply constraints, are having adverse spillovers on economic activity. While domestic demand remains resilient and manufacturing and services sectors activity continue to expand, there are incipient signs of moderation in some sectors as suggested by high-frequency indicators. The MPC was of the opinion that there are considerable risks to the baseline assessment of inflation and growth, which I am going to present shortly, due to the uncertainty about the duration and intensity of the conflict, magnitude of its spillover effects, and the pace of restoration of supply chains. Additionally, the food outlook too remains uncertain on account of subnormal southwest monsoon forecast and El Nino. Although risks of higher inflation have amplified, the MPC felt it would be prudent to wait for greater clarity to emerge. Accordingly, the MPC voted to keep the policy repo rate unchanged. At the same time, the MPC will continue to remain data dependent and closely monitor the developments, including supply side pressures getting embedded in the general price level and inflation expectations. As mentioned, the MPC also decided to retain the neutral stance. I now come to the assessment of growth and inflation. First of all, growth. The second advanced estimates released by NSO placed India's GDP growth for last year at 7.6%. This is owing to strong expansion in private consumption as well as fixed investment. Robust performance of manufacturing and services sectors were the growth drivers from the supply side. As per several high-frequency indicators, domestic economic activity remained largely steady even since the outbreak of the conflict. India's manufacturing and services PMI further suggests that both sectors continue to be resilient and business expectations are still positive. On the demand side, private consumption aided by discretionary spending has remained resilient so far. Fixed investment has also maintained its momentum despite cost pressures. Merchandise exports recorded strong growth in April this year. This is notwithstanding elevated freight and insurance costs. Services exports are also holding up well, reflecting sustained demand despite concerns about AI. Overall, the economic situation has broadly exhibited resilience and withstood the conflict spillovers, although the impact of cost pressures is becoming visible. Going ahead, the rise in prices of energy and other inputs, coupled with supply disruptions, is likely to weigh on economic activity. While import diversification in affected commodities is likely to improve supply, it would still come at a higher cost. The full impact, however, will depend on the duration of the conflict, the time taken for normalization of supply chains, and the burden sharing approach among the various stakeholders. The pass-through of higher energy prices to retail products is also becoming evident. Additionally, the projected deficiency in the southwest monsoon will have implications for agriculture production and rural demand. However, the programs and initiatives for crop diversification, water harvesting and conservation, climate resilient practices and short duration crops, among others, are expected to mitigate the impact. Sustained momentum in services, continuing impact of GST rationalization, and broadly stable employment conditions should continue to support urban consumption, even though rising inflation could be a drag on the purchasing power of households. Government capex is expected to remain robust, while the elevated capacity utilization and sustained credit flows from bank as well as non-bank sources are supportive of corporate investment. Cost escalation and heightened uncertainty could, however, dampen investor sentiment. Weak global demand and high logistic costs are also headwinds for merchandise exports. Services exports, on the other hand, are expected to sustain their momentum as demand for Indian services remain healthy. Risk off sentiments and safe haven demand are imparting volatility to forex markets, with a depreciating trend in many EME currencies. In this backdrop, the Monetary Policy Committee met on the 3rd, 4th, and 5th of this month to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC voted unanimously to keep the policy repo rate under the LAF unchanged at 5.25%. Consequently, the STF rate remains at 5% and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance. I shall now briefly set out the rationale for the decisions of the MPC. The committee noted that the global environment has deteriorated since the last policy meeting in April, with the conflict lingering amidst a fragile truce. The adverse implications of the extended disruption in supply chains and elevated energy prices are reflected in the moderation of growth and increase in inflation projections from the April policy, and I'll come to these a little later. CPI inflation remains below the target despite global shock, as the pass-through to domestic prices has been limited, while the baseline projections point towards headline inflation firming up towards the upper tolerance level in Q3 this year. The impact of the supply shock is expected to wane Q4 onwards. The underlying inflation pressures continue to remain benign at this juncture. However, generalization of inflation through second round effects on expectations and wages is a distinct possibility warranting a close vigil. The outlook also remains clouded due to the subnormal southwest monsoon forecast and El Nino risks.